This would be a shoulder.
That would be a shoulder, and then go to where we peaked. The last couple of days. Now, if that comes down to like, let's say 4,200, if that comes down to 4,200 and then rebounds, you see, that would be another shoulder. Now the head there.
Oh, I see. I see. Right. It's like
Yeah,
shoulder,
shoulder. Yeah. Now,
shoulder.
and the head, that, as far as the head, that would technically, that would be called a complex inverse head and shoulders bottom.
Right.
And you
Right.
do see this sometimes in shoulder patterns where there's heads and shoulders like all over the place. Maybe in 2 or 3 years, if we're at the end of the decade and gold's at 9,000 and it's silver's at 200 and they're off the charts and the stock market's down 40%, then you would say, okay, this looks a lot like the mid 70s where you could get that really sharp drawdown, but we don't have anything like that.
Gold and silver may be entering another important phase, while the mining sector is beginning to show signs of renewed strength after a difficult stretch. Vince Lanci, a precious metals market commentator, and Jordan Roy-Byrne, a respected precious metals analyst, emphasize that the latest rebound in gold stocks looks more like a bullish reversal than the end of a major advance. Similar powerful weekly moves following deep declines appeared around important lows in 2008, 2016, and 2020, suggesting miners may already have established a meaningful bottom. Gold is also developing a potential inverse head and shoulders formation. If that structure completes, the measured target could point toward roughly $4,400. Even a temporary pullback toward $4,200 may still fit the broader bullish picture if buyers step back in and push prices higher. Silver presents another notable setup, with the technical structure suggesting a possible move toward approximately $68. Looking further ahead, a much more aggressive and conditional scenario could eventually place gold near $9,000 and silver around $200 by the end of the decade if the precious metals cycle strengthens substantially. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
We're not coming out of a stagflationary era. We may be going into one. And so that's your comment
Exactly.
about
That's why I mentioned,
fundamentals.
yeah, that's why I mentioned maybe in 2 or 3 years. If we're at the end of the decade and gold's at 9,000 and it's silver's at 200 and they're off the charts and the stock market's down 40%, then you would say, okay, this looks a lot like the mid 70s where you could get that really sharp drawdown, but we don't have anything like that. And also, if as far as pure price action, if that were going to play out, what you would need to see happen, which would be a little similar, is basically gold would flatline here around 4,000, basically into next year, and then you'd have some big move down. That's basically how it played out.
Right.
But fundamentally, I don't know if you could really make a case for that.
Okay, cool. Right. So, I mean, that's the bottom line. The bottom line is the analogs, which you created to be a guide to see if history would, in fact, rhyme or not, have turned out to be very reliable for these particularly relevant analogs. I'm using the word twice. 1973, 2006, and 2008. 2008 is still remains to be seen, but that's down here, over here. But, it's only 2 months away from this low here in the black line to 2008's low. It's only 2 months. So it's actually less than 2 months. So
that's a good point, because if you actually zoom out or did this with a weekly chart, and again, if we were to zoom out and look at a 5-year analog or something like that, they would all look really, really close.
Right. The differences would go away because you're zooming out a little bit. What about this chart here?
Okay, well,
did I go too soon?
Well, the last point I was going to make in regards to 2008, the 01 to 08 move in gold. So that was corrected 30% 2008. It was actually similar to the 2018 low to the 2026 move that we just had. So if gold were to continue lower for a couple more months, I mean, I think the odds of that are very low now, but if that were to happen, it could make sense given that the 01 to 08 move in terms of duration and percentage gain was very similar to the 18 to 26 move.
Right. And that's when you'll draw up. If we start to turn down, you'll pull up that 18 to 26 move.
Yeah, I mean, the gains were like over 300% in both cases. and the timing was somewhat similar. So that's the link. That's the link historically, the 2008 move. But yeah, we can move on.
Okay. So explain this chart to me. Let me make it bigger. What is this chart?
Okay, so you can also do this with GDX, but I chose the Huey because before we had GDX and GDXJ in the mid 2000s, this was the go-to gold stock index in the early 2000s. But down at the bottom, we're just looking at the 1 week rate of change. What is the 1 week performance of gold stocks? And so I'm looking at what were the other periods where we had like a 15% or 20% up move. And I remember I actually looked at this in 2025 because in the middle of 2025 or early, we did have a huge move there, which was actually, yeah, right there, which was actually part of a breakout move. So I remember looking at that and realizing this is actually bullish. This is not bearish when you have this huge move higher. So looking at the history of this, Vince, we can see that, like, let's look at the context. So the context is this has just happened after a 40% decline in the gold stocks.
Right.
Now, if you look at the beginning of the chart, some of those moves were actually at the end of a move. So the very beginning, you have the '01, that was an interim peak there. You had it in '02, so basically blow off. That's the word I was looking for. So if this move comes in a blow off, it's definitely bearish. And you can see in the early 2000s, it came in a blow off. However, we noted 2025, which you circled earlier, and then also 2003. Like you could circle that one in 2003. That was similar to 2025. Those were breakout moves. So those were in the middle of breakout moves.
Oh, you mean
You can
this one
see
here?
there. Yeah, you can see that was a breakout move. So
So the blue dotted
okay,
lines, the blue dotted lines.
yes,
Right,
it's
right.
all
Okay.
yeah, it's all the blue dotted. Okay, but so we looked at the ones that were in the middle of a breakout or the ones that were blow off. That's the wrong context. The right context is basically after a steep decline in the sector. So you can
Right.
look at 2000, you can look at 2008, 2020, 2016, and now those declines were steeper. Gold stocks were probably more oversold then, but what did they all tell us? They all were bullish and signaled that.
That you don't fade the knee-jerk rally after a decline.
Right. And there's one caveat that I do want to mention. In the middle of 2015, there is one there. That thick line, yes. So this would be the worst case with the current context, where the market came, it was still bottoming. Like you had a 15% move, but then it came back down for a couple months, was still bottoming. And what happened? Well, it made a false new low in January, and then the gold stocks went up 60% in the next 4 weeks.
Right.
So
Right.
that's aside from that, it basically tells us definitively that the recent low in gold stocks is definitely in.
Knock on wood. Knock on wood.
The behavior of gold miners after their recent decline is drawing attention because sharp rebounds can reveal a major change in market sentiment. Instead of sellers remaining in control, strong buying pressure has returned quickly, suggesting investors may be becoming more willing to take exposure to the sector again. Historical comparisons are also important because some of the strongest recoveries in mining stocks have appeared after periods of intense weakness. When a market absorbs heavy selling and then responds with unusually strong upside momentum, it can signal that conditions underneath the surface are improving. Another key factor is whether that strength can hold through the next period of volatility. Sustained buying across miners would provide stronger evidence that confidence is returning to the broader precious metals space, rather than this being only a short-lived bounce. The coming price action may therefore be less about chasing individual moves, and more about watching whether strength continues to broaden across the sector. Now, let's get back to the interview.
So this is gold being bought by China, being held not by their central bank. And this is bigger than this. This is the tip of the spear. This is the actual spear that they're buying. So that's it. That's the physical proof. That's the statistical proof that China's demand is the reason that the market bottoms. I mean, I think it's very, it cannot be overstated how important this is. That our observation that China, let me see if I can put an arrow up here. China buys as the market's dropping, China buys as the market's dropping, China buys as the market's dropping, and China buys as the market's dropping. And when the market rallies, they stop buying. They're stackers. They're not short-term traders. Anyway,
Can I add one comment to that?
sure.
Okay, we don't see it in 2018, but aside from this, when was the most significant bottom if we're going back? 28, that was the most significant bottom before 2022 was 2018. Now you can't see that. Now 2018, I think if I recall correctly, I think that's when China suddenly really started to buy a ton, pun intended. I think if you're looking at their yearly buying,
Right.
I'm just going
Right.
off memory. Suddenly 2018 had this huge spike and it's strong since then.
I remember what happened. I remember enough to fill this in. If you're looking at the chart of Chinese buying ramped up between 2016 and 2020. And then in 2020, it fell off a cliff because of COVID. And then through 2020 and 2021, there was no buying. And then they ramped up again in October of 22. So yeah, the Chinese buying in this area here before 2020 was up. Yes, I do remember that. If we had a chart handy, we'd show that.
Okay, yeah, I'll throw something up in post-production.
Yeah, sure. And again, this chart on the right here is also significant. Now, if that's not enough, but there's more, Jordan, there's more.
Like Billy Mays.
Right, exactly. Now, all right, so this is a chart of Chinese non-monetary imports, less total reported central bank. So what are non-monetary imports? Non-monetary imports are imported gold that doesn't go through the bank or isn't bought out of London. So essentially, that's ETF buying, that's retail buying, that's private investment buying. And that has been almost off the charts for them recently. In fact, this is insurance company buying. Insurance companies are buying gold in China as part of their insurance products now. So when you factor in the PBOC, which is the official flagship buying, with the OTC, which is that London buying that I showed you, with this Chinese government owns gold through its people concept, well, China's been buying a lot more gold than people know. And that's because they're setting up for gold to come out of the closet, so to speak, and become an HQLA or repo asset. Gold's going to be competing directly with treasuries in this Hong Kong venture that they're talking about. Let me stop sharing. All right. So that's China. That's the biggest catalyst.
Can you see there's a very small inverse head and shoulders? Do you see that? You can see the three bottoms in gold, right?
Yeah.
Do you see
You
those?
mean, wait, hold on. Let me get my drawing tool here. You mean 1, 2, 3?
And then do the fourth one.
Oh, so you want to go 1,
1, 2,
2,
3.
3.
Yeah. So
Yeah, here's your
and if you
shoulder,
and if you yeah.
head, shoulder.
And so that I was looking at this last night. I think 4170 down to 39. So roughly speaking, this could possibly get to 40. Would that be 4,400? I think
We're already there.
We're basically already there. But actually, here's something that's interesting, Vince. I don't know if this is going to play out, but go to what you drew first, the first circle.
That's one of those trend lines that didn't pan out.
But yeah, the two big candles right there. If you circle that. Now we've probably gone too far, but like if we made another shoulder here, like if you just look at the next couple days, like if we were to come down to 4,200,
Right.
then you would have an even bigger head and shoulders bottom.
I don't follow you.
Okay, well that's a shoulder.
This would be a shoulder.
That would be a shoulder, and then go to where we peaked. The last couple of days. Now, if that comes down to let's say 4,200, if that comes down to 4,200 and then rebounds, you see that would be another shoulder. Now the head there.
Oh, I see. Right. It's like shoulder,
shoulder, yeah.
Shoulder.
Now, and the head, that as far as the head, that would be called a complex inverse head and shoulders bottom.
Right.
and you
Right.
do see this sometimes in shoulder patterns where there's heads and shoulders like all over the place. But I don't think that's going to play out, but it was something I was thinking about a couple days ago.
Right, right, right.
I
This
guess
would,
it's honestly it's still possible. Like if we pull back right now to 4,200,
well, isn't the complex head and shoulders consistent with this as a rounding bottom?
yes, you're right. Yeah. They look very similar.
Right. Like,
And I think on silver, you can actually pull up silver. I think silver has the same formation.
let me get it.
And I think in spot silver, the measured upside target, and we said for gold 4,400, I think it's 68 in silver. But I have to
That's
double
funny.
check
That's
that.
my target. Here, I'll pull up silver and you'll see where my dotted line is. There's silver is more obvious to me, right? I mean, except that. So here's your shoulder, head, shoulder,
Yeah.
break the
Neckline.
neckline, and that dotted line, that's my
Yeah.
target. I did a measured move from here to here. I said here to here, and I added it, and I said, there's my measured move. So 68 is my level.
Yeah. My neckline's probably a little smaller than that because I'm connecting. Yeah, I'm connecting there and there
Right.
to the right there.
You mean,
Well, when you draw the neckline, yeah, but I'm drawing like a trend line lower, so it's connecting. What day is that? Like it's connecting July 22nd, that peak. So you're connecting,
oh, so you're connecting in here?
yeah, like I'm connecting yeah, like that. I take the midpoint from there and then the one you drew earlier. No,
Okay,
I'm drawing like a
so
downtrend line.
here's my line, there's your line, and you're saying
I'm taking
you're
the
compromising
midpoint.
and picking
Yeah,
this line.
yeah.
Interesting.
Because of the trend. No, see if you can draw a trend line from the July 6th peak. So the July 6th peak down to
There
oh, wait,
or there?
there. Yeah, that trend line. Yeah. So that's how I got it.
Oh, I see. So it's like a slanted head and shoulder.
Yeah.
Right, right, right. A twisted neckline. Yeah, yeah. I see it. But regardless, we both came up with 68.
Yeah. Either way, 68 is a strong target.
Okay, great.
And so we're not there yet. And so even today, there's some pretty violent gaps in precious metals miners. So that to me is something to watch in the next week or two.
Well,
Yeah, go ahead.
yeah, I'm sorry.
I still think we're going to fill these gaps, but given the chart that we showed earlier about how you have this big 1 week move and it's bullish in the context, I mean, who knows? That's why gaps drive me crazy.
Right.
And you get a lot in precious metals because gold and silver 24-hour trading, they're gapping all over the place.
Yep. Right, exactly. Gold and silver trade 24 hours a day, but the miners don't, so you have nothing but gaps on your domestic charts. That's right.
China's role in the gold market adds another layer to the bigger precious metals story. Buying interest appears to become stronger when prices weaken, while demand tends to cool as prices move higher. That behavior suggests accumulation may be driven by longer-term strategic thinking rather than short-term momentum alone. The significance goes beyond official purchases. Broader participation from private investors, funds, institutions, and other domestic sources can deepen demand and help absorb periods of market weakness. When consistent physical and investment demand develops beneath the market, short-term corrections can look very different from periods when buyers are absent. At the same time, the mining sector remains an important barometer of confidence. A sustained improvement in miners would suggest investors are becoming more comfortable taking risk across the precious metals complex rather than concentrating only on physical gold. The broader picture is therefore being shaped by several forces at once: persistent accumulation, changing investor sentiment, stronger participation in mining shares, and continued interest in precious metals as a strategic asset. How these trends develop together could determine whether recent strength becomes part of a more durable market cycle. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.